Hi everyone. So chapter 25, the source of finance. It's a very for a financial manager. So if you are up right now, if you are working in the financial sector, or if you have ambition to work in the financial field in future, this lesson will be really important because you can see the source of finance mean every business organization, the financial needs are different. It can be short term or it can be long term. So whatever the financial needs we are going to find out different sources available today. So mainly today in this session we are going to find out mainly the internal source of finance available for a business organization. So all business need finance. Another similar name for finance we can see money. There are a number of funding sources used by organization. Business need money for different purposes. In this case, you can see startup business, startup capital, money. Startup business organizations, if you want to start a small business, t-shirt selling business, whatever the business, you need money. So it's another very important thing for startup business. We need startup capital. And another thing is to run the business. To run the business, or another term we call working capital. Startup capital, working capital. These are two types of capitals. Startup capital means in order to run the business organization, like starting the business, we need the initial capital. We call owner's equity. The initial investment is important to buy our raw materials, to buy equipments, to purchase some materials, and to pay for the suppliers, advances, to pay for the overhead. So many expenses are there. The initial startup and startup capital. And when you're running the business, when you open and running the business, we need some additional capital to money to run the business. We call working capital or circulating capital. For example, like you have to pay rent regularly, monthly, you have to pay rent if you have a rented building. And if you have workers, you have to pay their salaries and wages and all that. You have a utility bills you have to pay. The bills will be coming like electricity bills, water bills, telephone bills, and so on. And also, when you're running a business, we have to pay some kind of like a taxes you have to pay for the government, right? Like that, there are many more expenses are there you have to pay when you're running a business. So people need money for that as well. And the third reason given here is you can see if you want to expand your business into another territory, so we call that situation expansion. You need capital for expansion purpose. So startup capital, working capital, expansion. So you can see if you want to open up another branch, right? If you want to expand your shop network, we need more money. So that case, sometimes you can use your own money that you have saved from profit, or you can go for a bank loan, or you can go for an investor, or you can sell shares in stock exchange. There are so many options. We are going to, in this lesson, we are going to find out the different option methods, especially internal options today in this session we are going to discuss. And in this picture is not there. There's another important need is there for business. For example, money for emergencies, finance for emergency funding. For example, in case if there is a theft, if there is a fire, if there's a machine breakdown, there is a important repair coming up. If you have to pay important like a licensing fee or something, you have to pay some important deposit to the government. So you have to pay some kind of important like a down payment to a supplier. Like that kind of emergency funding comes. Then you have to have another source of funding for emergencies. Some business organization, they are keeping another reserve for that emergencies. For example, for foreign exchange fluctuations. If foreign currency fluctuates, then sometimes you have to pay more than you expected for your imports. When your import is something from other countries, sometimes when the currency depreciates, then you have to pay more. Sometimes you agreed with the supplier formally, but some organizations they don't have any like forward agreements like that. So sometimes you have to pay for the spot rate. So if you believe that your currency the value goes down like that, sometimes you have to keep some amount of money with you as a reserve for the emergencies. So you can see there are main 4 reasons why business need money. These are the 4 reasons: startup capital, working capital, expansion, and emergency. So one by one we'll discuss again. So you can see startup capital, like pay for the premises, new equipment, advertising, right? So startup capital means the funds are more need when the first setting up a business. right? This is because a lot of resources are needed before trading can begin. And some of these resources are one-off items. For example, a new restaurant would need to buy cookers, refrigerators, utensils, furniture, glassware, and other equipment, including knives, fork, and plates. Once these one-off costs have been met, they may not be repeated for many years. So other startup costs might include research, converting premises, legal fees, website design, and marketing, everything. So you can see these are the main expenses that you have to bear when you're starting a business, startup business. You can see these are the, for example, for a restaurant, they are given kind of examples that all the startup capital, equipments, everything you have to purchase. The second point, the working capital or running business, you can see when you want to run the business, you must have having enough cash to pay your staff wages and suppliers on time. I think my explanation, I explained this working capital means circulating capital. You need to have some kind of money in order to pay your day-to-day expenses. And third reason is expansion. Yes, business need to actually keep some kind of amount of money for expansion purpose, like having funds to pay for a new branch in a different city or a country. That's called expansion purpose. Once a business is established, the owners often want to expand, right? So they may want to expand the capacity to meet the growing orders. Like you want to increase new warehouse, increase the capacity of a new warehouse. You want to buy another building, right? If you want to the capacity of the the office premises, you have to expand. That's kind of a expansion purpose. Can be not only branching out, sometimes the current location, the current premises, the square feet sometimes not enough. You have to expand it, like in order to meet the growing orders. And develop new products. Sometimes you have to introduce new products, research and development, so that we need that money for that. And also branching out into the overseas markets, that's another expansion policy. Like branching out situation, you can open up branches in every town, every city, every province, every state, like that. So branching out is important. You can see, if you take example about like the famous supermarket Walmart chain in USA, they have more than 7,000 branches worldwide, including Europe, USA, right, and some African countries, and mostly, mainly USA, and European countries. If we take the example of like another fast food franchise like McDonald's, they have about 12,000 branches, right? KFC, Pizza Hut, like that. You can see like number of branches they are operating. The branching out program need money. So more branches mean more revenue, because you have to cater more customers. The only option that you can, the only way that you can cater more customers is branching out. That kind of particular businesses, right? So that you need to have spend some money for the branches, like you have to buy some places and rent some places. You have to refurbish the location. So many things are there. We call this brick and mortar cost. But that's why the new trend of the business coming online business, because you don't need to actually branching out, having a massive, right, right, branch network is sometimes very difficult to administration. So online business, you get the example like Amazon, like get the example like AliExpress, Alibaba's. So these business organizations are the biggest retailers, giant retailers in the world, and they're the richest people in the world now. Jeff Bezos. So they have only one website, right? They're selling everything all over the world. So imagine that's a new trend, because people also like to actually visit these branches and online shops through their smartphones and smart devices. So therefore, there is no brick and mortar cost. That's a new trend of business. Very easy, very comfortable, but you have to do just the maintenance of the website. So you can do all operations in one head office is enough. But you must have warehousing and supply chain management, transport and logistics. That section you have to manage properly, because that's a different module of the business organization, right? So that online business format is another different format. So therefore, you don't need to have branching out, but you have to operations and everything, the hubs, like especially warehousing and everything, you have to manage properly. So that will be, we are going to discuss in a separate lesson called online business, online marketing. In there we discussed that part. Okay, another thing is diversification. Diversification means an organization, they can actually operate they can actually find out another business line. Sometimes the people who are doing, supermarket chain, they might invest in a hotel. They can actually start the tourism sector. There are only about 25 economic activities are happening in the world. Like all that economic activities, you can number like 25 activities like transport and logistics, hotel and tourism sector, education industry, and you can see building the construction industry, okay, the medical industry, the scientific industry, and IT, information technology. Like that, there are certain industries out there. If you want to diversify your business, imagine right now we are working in the information technology business, IT business, and if you want to diversify it into, imagine into a hospital, like a health sector, then you can start that's called the diversification. If you start a hospital, right, from right now you're in IT sector, so that means that's called diversification. From hospital sector to if you start a hotel, like tourism and hospitality sector, that's another diversification. And after, if you start an airline, or sometimes if you start some kind of like cab service, like Uber, that's called transport and logistics sector. Like that, there are different, about 25 economic activities are there, which runs the entire world. So if you change your business modules, if your business activities, that's called the diversification. If the person who are running a school, if we start a hotel, that's called diversification. The person who start running a hotel, and if we start some kind of a, let's say, jewelry shop, or a manufacturing of construction of houses, apartments, that's a diversification. So I think you can find out for these reasons, you need to have a money. And also I am explaining here the emergency funding also. Emergency funding means in case of machine breakdown, a natural disaster, in case of fire, theft, burglary, right, tsunami, something, cyclone, natural disaster. You can see sometime overnight your warehouse will be gone. So you need money to recover. Insurance will be there. So these are the main 4 reasons. So what are the 4 reasons? Startup capital, working capital, expansion, and the emergency fund. Right. Now, under the topic sources of finance, you can see new business find it difficult to raise finance because they usually have just a few customers and many competitors. So lenders are put off by the risk that the startup may fail. If that happens, the owners may be unable to repay their borrowed money. So mainly, that's why when you're startup business, like only just a small business organization, it is very difficult to raise finance. You can see like that is we discussed under sole traders. If you remember, one of the drawback of sole trader business or sole proprietors is actually difficult to raise finance, because the entire financing thing, the capitalization is very hard, because he finding out everything alone, right? Everything alone. So you can see the second topic is source of finance. Uh, some source of finance are short term and must be paid back within a year, right? So mainly you can see the idea, the source of short term source of finance mean the funding sources, the financial needs, financial urgencies, which must be paid back within a year. So annual, within 12 months you have to pay, right? There is no other exemption. So only 12 months you have to pay. Short term is like that. There are several examples. So the lot of other source of finance are long term. Long term mean you can pay back over many years, right? Some loans are there, you can have to settle within 12 months, within one year, sometimes can example, let's say trade credit, right? Trade credit, sometimes you have to settle the trade credits sometime within 2 months. A lot of people doing credit transactions. Imagine your credit card bill, you have to pay within 45 days. So these things short term, you can't like that in for years, right? So but some loans are there, some source of finances that you can pay up to like 10 years, 15 years. There are some bank loans that you can pay over the 10 years, 5 years, like leasing, mortgages. So these things are going to learn step by step. You can see today the main our focus is internal sources, right? Internal sources. So internal source of finance are funds found inside the business. So you can highlight uh, internal source of finance are the funds or money which come from inside the business, funds found inside the business. Please, you can highlight this statement. This is the important definition of internal source of finance. For example, profit can be kept back to finance expansion. The profit that you're earning, you can save it. You are telling for a sole trader, for a personal income, if you save like that, we call personal saving, right? But if you're doing another business, for example, if you have a business profit, we call it retained earnings. Retained earnings. Alternatively, the business can sell assets or item it owns that are no longer really needed to free up the cash. So I think they are giving the keep up a little bit elements to savings, retained profits, and selling of assets, sale of assets. So mainly the internal sources, the definition you can write down there again, the internal sources mean the money, the funds which found inside the business organization, right? So in this topic, you can write down the space given, like normally the internal sources are the money that you can found within the business, right? Sources of available, the funds which are available within the business, we call internal sources. Let's go to the different type of internal sources. There are only three major internal sources available, which is personal savings, retained profit, selling assets. So personal savings, another name we call say owner's capital, equity, right? Owner's capital, personal savings, retained earnings, selling assets, right? So this is our main focus today, to understand the main idea and the advantages and disadvantages of this each and every three sources. Personal savings. Look at the personal saving description. When business is set up, the owners are usually required to contribute some finance. It would be rare for an entrepreneur to set up a business in which all the money needed to get started, right, came from an external source. For many small businesses, the capital provided by the owners come from personal means. Entrepreneurs might use redundancy money. Redundancy money means if sometimes if you work somewhere and if you lost the job, or sometimes an organization told you to actually, sometimes they ask you to leave. If they're saying that okay, like you are no longer required for business, sometimes say they can reduce the size of the organization because of the as a strategic plan, or because of the imagine like business is going to reduce their capacity. So that kind of program, sometimes a lot of people might reduce in their jobs, they are losing their jobs. So that case, sometimes organization has to give some compensation for the workers who are leaving the business because of the company's want, not because of the fault of the workers. Its company requests them to leave, but it's unfair to tell them to leave without any compensation. So that's compensation part we call redundancy money. If someone have a doubt today, if you're learning this word today, it's important. Redundancy means it's kind of an employment benefit at the end of the termination of the contract of the worker. That company, when ask them to leave, the company have to pay some kind of a compensation in order to make it like a fair termination. So redundancy money sometimes is using as a result of sometimes funds they saved, so they are using this as a personal savings. If they have idea to start their own business, they're using this redundancy money. And also sometimes they're taking loans or gift from relatives and friends, right? If you remember that the first chapter we talk about the candy cycle shop case study, we talk about that candy cycle shop that Mr. Taranga, he was actually using his money from grandmother. 300,000 is using grandmother's money and also his own money by working in a tea estate to start a small cycle shop. Like that is here the personal savings, and sometimes money coming from as a loan or gift from your relatives and friends. Sometimes your father, mother, auntie, grandfather, grandmother. So they might help you out. So there's also another personal savings. And also sale of personal belongings or personal savings. Sometimes you can sell your jewelries. Sometimes you can sell your old, furniture, whatever. You can sell your own. Sometimes you have a house or a land or something. So that causes another type of a personal savings. Or personal savings is likely to be the most common source. Some entrepreneurs have saved for many years in the hope that one day they might have enough money to start their own business. Right? If you remember that the case study, the Maurice Obaya's case study, the taxi business, right, in Kenya, Nairobi, he used the Kenya stealing 2 million of his personal savings to help from the start his airport taxi business. Right? There are so many examples in this world how they find their own personal capital. For example, the Amazon, right, the Jeff Bezos. When he started his business, Amazon website, first of all, he started his redundancy payment, like he used some kind of funds, his personal savings, by working as an investment banker, right, in one of the greatest company in the UK, USA. It was investment bank by profession. It's like a very promising job, but he quit the job in order to just start his own business, Amazon, start selling books online. But now he's the richest person in the world, more than 130 billion US dollars, right? At that time, he took a risk and came out from that promising job to start his own business. Everyone actually laughed at him. Are you selling books now? But now he's selling everything A to Z through his website, and it was an amazing idea called Amazon, right? So second reason is a retain. Normally, if you talk about it a little bit more, the personal savings, you can understand, right? The personal savings, you don't need to pay any interest to anyone because it's your own money. You don't need to worry about it. You have like a full access to your own capital. Anytime you can access without any interest. No need of documentation. It's like my car, my petrol thing. So personal savings are very freely available, no cost of capital, and no time consuming, and no administration cost, nothing. It's very quick cash. But the main problem, the main disadvantage of personal capital is sometimes it is not sufficient enough. It depends on person to person. Sometimes it's not enough for you to start a new business. It's very small amount. That's why they're going to other sources. That's why they're asking another bank loan. Sometimes the amount of money you collected is not enough. To start a business, you need, for example, you need, imagine 2 million. 2 million. But right now you have only, imagine you collected only 1.5 million, or let's say 1 million only. Then definitely you have to go for another option in order to collect the balance. Right? Like that, personal savings are like that. A lot of people are right now, they're using personal savings plus other methods. So in future, we are going to talk about so many methods, like online methods, like normally there are so many like websites are available, like a crowdfunding websites and everything. There are marvelous opportunities are there right now for the people to raise money. The second most important internal source is the retained profit. Retained profit. Retained profit actually now the exams, there are so many times this was tested. Sometimes this kind of questions can become as a 9-mark questions. Justify which option is the best. Retained profits or bank loans. Retained profits or selling assets. Retained profit or personal saving. Retained profits or mortgage loan. Retained profits or share capital. So retained profit is always there. Retained profit you have to understand very well carefully the definition and two advantages and two disadvantages. So retained profit that has not been returned to the owners, the profit that has not been returned to the owners. This is a simple definition, right? So the profit that has not been returned to the owners. So it is retained by the business. It is an important source of finance for business because it is cheap. First advantage, here we go, cheap, right? No interest at all, right? And there are no charges involved. Second advantage, cheap. There is no charges involved, such as interest, dividends, or administration. Okay, so the advantages, it is cheaper and easy, right? No administration costs. I think there are more than 2 advantages. However, look at the disadvantages. If profit is used by the business, it cannot be returned to the owners. Some owners might object to this first advantage. Some owners might not like to use their profit because you cannot recover it again. If you use the profit, that's it, right? You cannot use it for dividend payments again. Therefore, most of the shareholders and directors will not like to use this situation. They don't like to use their retained profit because of this situation, because it's their savings. And also, retained profit is also a flexible source of finance. Another advantage. It can be built up by the business and kept in a bank account earning interest. That's what they do. Every year, the amount of money you're earning, you're collecting, you're saving in a bank account, right? And a business can then use this source as a later date. So this is the advantages. So you can use it very cheap, no charges, no administration cost, and you can use that money and you can keep this money in a bank account to earn interest. But however, the return profit main disadvantages is there can be some kind of objection can be come from other shareholders that they don't like to use their return profit, because once you use the return profit, it cannot be recovered. Right? Moreover, another disadvantage of return profit means sometimes the available return profit is not enough or sufficient to do something. Right? Definitely it's not sufficient. Return profit is there. Same like personal savings. Sometimes return profit also not enough for the project. Imagine you want to start if you want to construct another building, warehouse for the business, and that cost you, let's say, 10 million. But right now, with you, the return profit availability is only 6 million. So then, if you want to start that project, another 4 million you have to find somehow. Like that. So it's a common disadvantage, the insufficiency of funds in those situations. That's why, personally, if you are funding something, there can be some kind of limitations is there, because the sufficiency is not enough. Like, insufficient availability, that's a common drawback, a limitation of these things. Okay, the third and last one of the internal sources is the selling assets. Selling assets mean, again the definition, in an established business, may be able to sell some unwanted assets to raise finance. So simple definition, selling unwanted assets to raise finance. For example, you can say selling the assets in abundance or unwanted. If you have abundance asset, like if you have too much of assets, right? You have too much motor vehicles and too much of lorries, then what you can do? You can sell one because so much of the unwanted, right? You have 3 vehicles. Right now, you're using only 2. One vehicle is there without using, old vehicle. And you need to have a garage and the space, maintenance, insurance, everything, maintenance cost. So what you can do? You can get rid of that one. You can sell at a good price, right? Like that, to raise finance, for example, machinery, land and building that are no longer required could be sold off for cash. Large companies can sell off part of their organization to raise finance. We call this situation selling part of the business, we call asset stripping. Asset stripping, like, that is get rid of the asset. You're selling part of asset. This can be happen in case of like a recession. If you have a business becomes, like selling asset, it's a very common thing in situation of like a recession. If you want to get rid of some kind of unprofitable divisions, so this is there. Right, in getting started about the tribal group, you can see the like Maurice Obai and tribal group. The tribal group is education service provider. So they actually sold their synergy, sold off the synergy for 20.3 million cash, and synergy was a part of the tribal group, selling software to children's services department of local authorities. It has also possible to sell off assets that are needed by the business and these lease companies. Sometimes you can use the sale and lease back option also available. Sale and lease back option also really good. So that means while you are using the asset, you can sell the absolute ownership of the asset to a leasing company. And then you can get that money. For example, let's say you have a vehicle worth 50 million, right? So you can, from the leasing company, they will buy the vehicle for about 90% of the vehicle value they will give you, right? That means definitely they will give out 45 million for the 50 million worth vehicle. So then you can use that 45 million for the business use while you are using the vehicle. They don't take the vehicle from you. They're saying, okay, you can use the vehicle like leasing, but we are the absolute owner and you have to pay monthly leasing installment for the vehicle. So vehicles, lands, buildings, anything you can do like that, sale and leaseback option, right? You can still be the user, you can still use the vehicle, you can still use the building, but the absolute owner of the building, the absolute owner of the vehicle is leasing company, and you have to pay a monthly lease installment for them regularly until you settle the full amount that you obtain. So some people are doing this thing, they are taking this chance And they sometimes quick investment opportunities are coming, sometimes share market or something. Just quickly they grab some investment and they buy today and sell tomorrow, and they quickly settle the lease also. Sometimes that's why some people are doing like that, like selling and leasing it back is another good option. Selling assets. So these are the main three important internal sources, right? Personal savings, retained profit, and selling asset, right? So you can see, I talk about the advantage, disadvantage also very important. So past paper questions, always what you need to know, the advantages and disadvantages. And for a record, we can discuss about the external sources also, but not in detail, because today's session actually mainly I want to focus on internal. But look at the external. The external, there are so many options are available. Like internal, only three, if you remember: internal, personal savings, retained profit, and the sale of asset. But look at the external. External short term, they have three, and external long term, they have, right, 8 methods are available, right? These are 8 methods only just listed, but there can be more. There can be more. So this is the classification of the source of finance. It can come from internally and externally. Main three internal methods today we discuss in our session: retain profits, sale of existing assets, and cut down stock level. Cut down stock levels. So retain profits, sale of assets, and personal savings. So sometimes cut down stock level, but this one in above we didn't discuss. So cutting down stock level also internally possibility, that is a working capital management, like we call sometimes, like hair cutting or business downsizing. Business downsizing also we can see we can save some amount of money by that way, but mainly we're talking about the sale of assets, retain profit, and personal saving, these things, right? Interest also, these are things we discuss, right? So now you can find out internal and external sources like that. So I would like to go for like a one past paper question, which came from there. You can see here the MCQ questions, everything, and the availability of the money, everything. You can see now. Question number 1: which of the following best describe the finance? Finance is always, it's not customers, it's not profit, it's always funds for a business, like that. Okay, so like that, so there are MCQ questions also there in like my usual way. So like my other handout, this one also have MCQ questions, and you can see all the methods are available. Mainly today, my focus is the internal source of finance. But look at the external source. There are so many external sources available, short-term and long-term methods of availability. So let's take some kind of like a look at the external sources. So externally, we can use short term, and external, they can use long term also. So I don't confuse with this classification. For example, bank overdraft is external, and that can be only used for a short term, less than 1 year, right? So, and trade payables also like that, external, and we can use for only like less than 1 year to quickly settle it. Even credit card also same. But other method, look at the loan capital, unsecured bank loans, mortgages, debentures, hire purchases, share capital, venture capital, crowdfunding, all these methods you can pay back after 1 year also, like within 5 years, 10 years, 15, right? And definitely after 1 year, you can settle the loans like that external long term. So today lesson, just to wrap up, I think from there we can actually conclude this session. We can actually go to the revision part, the revise what we have learned today. So mainly talk about there are sources available in source of finance. There are main 4 reasons are available for a business, mainly startup capital, working capital, expansion, and emergency funding. So these things actually we discussed there. Startup capital is what, working capital is what, expansion is what, and the emergency funding is what. And after we talk about what is internal source of finance and external source of finance. Internal means funding generated from the inside the business or within the business. And after we talk about mainly, there are 3 internal methods are available: personal savings, retain profit, and selling assets. So personal savings main advantage is there is no burden, very cheap method, and there is no need to pay interest, right? No administration costs, those things, quick method. But the disadvantage of a personal savings is sometimes not maybe enough personal savings, and sometimes for a sole trader, sometimes it is not difficult to find a personal savings. Sometimes not personal savings are not enough. Sometimes the main drawback of personal savings is insufficiency of funds, and it's depending on person to person and business to business. Return profit, we talk about the profit that we kept by the business without returning to the owners. Return profit, we are talking this concept in companies, private limited companies, public limited companies. In because partnerships and sole traders, they actually 100% profit they share, they declare. Right? If you have two partners, they share the entire profit 50-50. They are not saving anything. But companies, they are saving like that because there's a policy. They are 100% profit, they are not distributing as dividends. So return profit is the that savings. So you can, main advantage again is the cheaper method and no charges, no interest. And but however, the advantages here, sometimes to use the return profit, sometimes there can be objection can be come from the other owners, and also return profit sometimes may not be sufficient enough for your project. Those are two advantages and two disadvantages. Selling assets is another method that if you have assets in abundance or asset you are not using, unwanted asset, you can sell it and to raise the finance. The major two advantage of selling assets is you can get a high amount of capital by a quick amount of capital by selling an asset, like selling a land, you can generate a good amount of capital to the project. And also selling assets is another thing that you need to pay any interest or anything because it's your own money, it's your own properties. So any emergencies also you can mortgage it, you can release it, right? Without selling, even you can remortgage it if you want to. If you want it, you can lease it back or sell and lease back. These options are available. Options are available, right? This but selling asset major disadvantage is selling assets. The organizations are normally they don't like to sell the assets. Sometimes for sole trader businesses, sometimes they don't have enough asset to sell, nothing to sell sometimes. So if you are a small businessman or if you are a startup business, selling asset is a dream because they don't have enough assets or no assets in abundance because it's just a startup. Therefore, this option is only applicable if you are like a matured, established business only. So I think you can keep those things in your mind. And after we just touch about the external sources available, that will be I'm going to discuss in my next session, guys. Right? So I think you can, if you have any doubt, you can ask it right now. Okay, that's about our lesson. Internal source of finance. I think I hope you understand the internal source of finance three method: return profit, personal savings, and selling.